Welcome back to the deep dive. Usually when we talk about the economy, it feels a little abstract, like reading a weather report for a country you don't live in.
Right.
But today, today we are getting into the actual plumbing, the pipes that move the money from, your pocket to the coffee shop to Amazon to an airline ticket.
And those pipes are carrying a lot of pressure right now. We're looking at the big three, that's Visa, Mastercard, and American Express. And these aren't just like credit card companies. They are the gatekeepers of global commerce.
Absolutely. And if you've been watching the news this week, you know the gatekeepers are dealing with some serious storms.
Mm-hmm.
It is Monday, February 2, 2026, and the market is, let's just call it spicy. We've got earnings season in full swing, political curveballs coming out of Washington.
And we have stock charts that are telling three very, very different stories.
Exactly. So our mission today is to decode this whole sector. We're going to look at the news, the technicals, the charts, and the valuations.
And we are going to see if we made any money. We're bringing back the paper money math simulation.
I love this part. Okay, so we're going to take a hypothetical $5,000, pretend we invested it in each of these companies exactly 1 week ago.
And see what happens.
See if we can afford a nice dinner or if we're, eating instant noodles tonight.
It's the best way to keep us honest. But before we start counting our hypothetical cash, I do have to give the mandatory disclaimer.
We're for it.
Everything we discuss today is for informational and entertainment purposes only. We are analyzing data and news. We are not giving financial advice. All investments carry risk, and you should always do your own homework.
Okay, legal box is checked. Let's set the scene. The broader credit services sector, it's facing some headwinds. And by headwinds, I mean politicians.
Yeah.
Everyone is talking about the Trump cap.
They are.
Right.
This is the big shadow hanging over the whole sector right now. The headlines are all buzzing about this potential cap on credit card interest rates.
Yeah.
And, on the surface, that sounds fantastic for anyone carrying a balance.
Right. Lower rates, less interest. Sounds like a win for the little guy. But I'm guessing the big three aren't exactly throwing a parade.
Definitely not. But here's the nuance, the part people miss. It's not just about the banks losing a little bit of profit. If you cap those rates, you effectively kill the interchange fees.
And interchange fees are?
That's the money merchants pay just to process a card transaction. And do you know what those fees pay for?
I have a sinking feeling you're about to say my airline miles.
Exactly that. Those rewards programs, the cashback, the airport lounge access, those aren't free gifts from the company. They're funded entirely by that interchange ecosystem.
So if the Trump cap slashes those margins...
The mathematical engine that pays for your vacation, it just breaks. So yeah, analysts are warning that loyalty programs could be completely gutted.
So the trade-off is what? Cheaper debt, but zero perks?
Precisely. Now, most sources are saying the cap won't stick. It probably won't become law. But markets hate uncertainty. So you add in the new Fed pick, Kevin Warsh, the Trump Accounts Initiative.
And it's just a recipe for volatility.
It is.
And amidst all this political noise, there's this tech story brewing too. Stablecoins.
I saw a headline about Visa's crypto chief getting pretty aggressive here. Are we finally, paying for groceries with crypto?
Not quite. And this is really important. Visa isn't trying to get you to buy coffee with Bitcoin. They're looking at the infrastructure.
Okay.
Think of it this way. Right now, moving money between banks is like sending a letter through the post office. It can take days to actually settle. Stablecoins, which are just crypto pegged to the dollar move like an email.
Instant
And cheap. Visa wants to own the rails that those digital dollars run on. They don't want to be the steam engine. They want to be the steel tracks.
So if stablecoins become the default way money settles on the back end.
Visa wants to be the one charging the toll. It's about future-proofing the plumbing.
Got it. Okay, let's get to the stocks. First up, the heavyweight champion, Visa, ticker symbol V.
The volume giant. As of today, February 2nd, the market cap is a massive $638 billion. And the stock closed at $333.84. And it had a pretty good day, up almost 4%. But zoom out a bit for me. How is the company actually performing?
They just released their Q1 earnings, and the theme was volume muscle. They beat expectations. Net revenue jumped 15%.
15?
There was a slight miss on processing revenue, but just the sheer number of swipes, the volume made up for it.
So despite all the inflation talk, despite these Trump cap fears, people are still just spending.
They are. The data shows real strength in winter sports and holiday shopping. The consumer is resilient.
Yeah.
However, if we look at the chart, The stock price isn't really reflecting that optimism.
Okay, let's talk technicals. I'm looking at this screener here and I see a lot of red indicators.
Yeah, it's messy. Visa is trading below its simple moving averages. Specifically, it's about 3% below its 200-day moving average.
Can you just unpack that for us? Why does that 200-day line matter so much?
Think of the 200-day average as the climate, while the daily price is just the weather. Right now, Visa's climate is rainy. When a stock is living below that big long-term line, it tells us that the big institutions, the whales, they aren't really buying it up yet. They're waiting. So technically, it's in a downtrend.
And what about the RSI, the Relative Strength Index?
It's at 49.41. It's dead neutral. Imagine a speedometer where 0 is stalled and 100 is redlining. 50 just means it's cruising at the speed limit. There's no momentum.
Okay, so great earnings, but a really boring chart. Let's see what that meant for our wallet. Time for our paper money math.
Let's do it.
Scenario. I'm the learner. I took $5,000 and bought Visa stock exactly 1 week ago. How did I do?
All right. So based on the price last week, which was roughly $328 a share, you would picked up about 15.2 shares.
Okay.
Now, despite that ugly long-term chart, Visa actually popped today on those earnings. So for the week, it's up 1.63%.
Okay, green is green. I'll take it. What's the profit?
You made approximately $81.50.
$80.
It's a nice dinner for one.
Yeah.
Maybe two if you skip the appetizers.
It's better than losing money, but it's not exactly a retirement plan, is it? It just feels like the market is shrugging at their good news.
That's exactly it. And the valuation is high. The PE ratio is over 31. You're paying a premium price for a stock that's just stuck in neutral.
All right, let's pivot to the rival, Mastercard, ticker MA.
The efficient one. Market cap is just under $500 billion. It closed today at 555.67 cents.
Now, this chart looks way different. I mean, it's up over 3% today, but it's been climbing all week. What is MasterCard doing that Visa isn't?
Well, they also beat earnings. Profits surged. But the real story, and kind of the controversial one, is the headcount.
Oh.
At the same time they announced these great profits, they also announced they're cutting 4% of their staff.
Hang on a second. You're telling me they beat earnings, profits are surging, the stock is flying, and their thank you to the staff is a pink slip for 4% of them. Make that make sense.
It's brutal, isn't it?
Yeah.
But Wall Street loves efficiency more than it loves loyalty. MasterCard is basically digging the trenches before the battle starts.
They're cutting fat now, so they don't have to cut muscle later if 2026 gets ugly.
You got it. They're streamlining to protect their margins.
And the market rewarded them for it.
Handsomely. I mean, look at the chart. Unlike Visa, MasterCard is trading above its moving averages. The climate here is sunny.
What about the speedometer, the RSI?
The RSI is at 54.58. So it's picking up speed, but it's not overheating yet. It's a classic buy signal for momentum traders.
But is it expensive?
Very. The PE ratio is 33.62. It's the most expensive of the group. You're definitely paying up for that efficiency narrative.
All right, let's see if that premium price paid off. Paper money math. $5,000 into MasterCard last week.
Okay, so at roughly $527 a share, you bought about 9.5 shares. The stock had a killer week, up 5.31%.
That sounds a lot better than Visa. What's the total?
Your profit is $265.50.
Now we're talking. That's a car payment. Or a very, very nice dinner.
It's the clear winner of the week. And it just shows that in this market, investors are really favoring companies that are aggressively managing their costs, even if it's painful for the employees.
Ruthless efficiency wins the week. Okay, let's check in on our third player, the luxury lounge, American Express, ticker AXP.
The high-end player. Market cap is around $243 billion. It closed at $352.83.
And it's basically flat today. But looking at that weekly trend, oof, it is bleeding red.
It is. The weekly trend is definitely down. And the culprit was their earnings report. They missed estimates.
Why? I thought the rich were still spending like crazy.
They are. Revenue was actually record high. But here's the catch. Customer engagement costs.
That sounds like corporate speak for points.
Exactly. To keep those affluent Gen Z and millennial customers swiping that Amex, they have to offer better rewards, better lounges, better perks. And all those perks cost money.
So my Platinum card benefits are basically eating their profit margin.
That is literally what is happening. They're bringing in more money than ever, but it costs them more to keep you happy. It's a classic margin squeeze.
So the chart must be just as ugly.
Short term.
Yeah.
It's trading below its 20-day and 50-day averages. It kind of looks like a falling knife.
But I hear a but coming. You usually like Amex.
I do, and it's because of the valuation. Just look at the PE ratio. It's 22.93. Remember, MasterCard is up at 33. Amex is trading at a massive discount to its peers.
So is it a value trap or is it actually a bargain?
Well, look at the PEG ratio. That's price to earnings growth. It's at 1.23. Visa's is 1.83. A lower PEG usually means the stock is undervalued relative to its future growth. So, if you believe the rich will keep spending, Amex is on sale right now.
Okay, but on sale usually means you lost money if you bought it last week. Let's just rip the Band-Aid off. Paper money math, 5,000 into Amex.
Here's the damage. You bought about 13.7 shares,
Mm-hmm.
and the stock is down 2.87% for the week.
Hit me with the number.
You lost $143.50.
Ouch. That is literally my annual fee vanishing into thin air in 5 days.
It stings. Yeah, the headlines say consumer strong, but the stock reacted to margin squeeze.
Yeah.
You paid the price for that mismatch.
So we have 3 really different stories here. We've got Visa, the steady volume giant that's just treading water.
Right.
We have Mastercard, the ruthless sprinter, cutting jobs to boost its stock price. And then we have Amex, the luxury player, kind of tripping over its own expensive rewards.
That's a perfect summary, and I think it tells us something really important about the U.S. economy right now.
Okay, so what? Yeah.
The thermometer says the patient is healthy, but also maybe a little feverish.
Yeah.
First, luxury is holding up. Amex's record revenue proves the rich are still spending.
Okay.
Second, companies are terrified of the future. I mean, MasterCard firing people while making record profits, that's a signal. They're bracing for a tough 2026.
And third,
volume is still king. Visa shows that this shift to digital, it's permanent.
and we can't forget that political wild card hanging over everything, the Trump cap.
Right. If that cap actually happens, and again, sources say it's unlikely, but if it does, it just changes the map for all 3 of these companies overnight.
Which brings us to our final thought. We always like to leave you with something to chew on.
Here's what I'm thinking about. We have Trump accounts potentially moving money into government ecosystems. We have stablecoins threatening to replace the old bank rail.
Now we have MasterCard proving that profitability doesn't mean job security.
Exactly. So are we looking at a sector that is becoming more profitable for shareholders, but less stable for the average worker and consumer? And if stablecoins do become the default, like Visa is betting, who actually owns the rails of the future economy? Is it a bank? A tech company?
Or something we haven't even regulated yet.
That's the multi-billion-dollar question.
Who owns the rails? Thank you for diving deep with us today. Check the screener, do your homework, and watch those support levels.
Stay curious and watch the volume.
We'll see you on the next deep dive.